Hello and welcome, guys. Today, very important show. We will discuss what actually Jerome Powell yesterday addressed in the FOMC meeting. We will discuss actually the market price and where we are heading next. And also, we will look to the liquidity levels. We will look to the ETF levels. We will look to our funds, how they are doing, and where we are buying and where we are actually selling. So, we will explain you shortly actually how you should play this market right, so you are not liquidated, so you are not basically running with the FOMO. So therefore very important to watch full the video from the beginning to the end, because otherwise you will just know a small piece of puzzle. So therefore look through all the video, listen to all the things I am telling here, because it's all is very important. They are the main and the most important things into the market analysis. So let's begin. Let's begin with the Fed interest rate decision yesterday afternoon, and basically yesterday night. FOM did just what was quite expected, didn't raise, didn't ease the monetary policy, so interest rates stay at 5.5%. What actually is more important is this meeting afterwards, where the chairman of the Fed discusses the monetary policy and economic in general. So, and there it was quite clear that basically there are no new surprises, and they still stick to 2% target, and they believe they will reach it in the next couple of months slowly. So therefore, also he said that there is a little chance that there can be some kind of even more interest rate hikes. So no more interest rate hikes accordingly to information currently available. So and regarding the quantitative easing, basically, I would like to add that there definitely will be such, but maybe not that quick as we expected in the first hand. And also, there is like two major things to monitor. First is inflation, and the second is job market. So, basically, the monetary easing can take place also in the moment when there is a problems with job market. If the job market is actually decreasing and there is more and more people without a job, then definitely also that will be the trigger to ease the monetary policy and the interest rates will be reduced. So therefore, there are like two main major things to monitor. As I told you, job market, and second is inflation data. And inflation data basically also when the Jerome Powell was asked basically where the inflation is coming from, he he was not able to answer directly, and he actually had no idea where it's actually coming from right now and where this increase can come. So in the next couple of months, I think also that there is not that much uh, of the areas where this extra inflation can come. It probably can come from the more political issues. If there is more wars and escalations, then there is also probably more inflation. But that's also will actually crash a little bit job market, and that is the other side of the coin. So therefore, still, I think this scenario that there is interest rate hikes, it's maybe less than 5%, maybe less than 1%. It's like really there is no evidence that we have to raise the hikes, and that's also what he addressed. And the secondly, also that we are just basically waiting until there will be the proof in data that we are sure, and we can actually also boost economy a little bit, and that will not boost the inflation, because inflation is the main thing here, as actually there is those, I would say the most important is to care about the population which are living from the salary to salary, from the wage to the wage, and they are spending all their money monthly. So, and if for those people the inflation is quite important, if the prices goes up, they still cannot then they cannot afford their living, they cannot afford their living standards, they cannot afford the basic things, and that's pretty dangerous. That's the most dangerous thing about all this monetary policy. Therefore, in the first place is this inflation data, and we cannot actually leave the inflation running, because then there will be more and more homeless people, more and more unemployed people, and there will be a lot of problems. So, and therefore, this is the first place, and that's actually what the Fed said yesterday. So let's go on. And in that sense, actually, the markets reacted well, because there was not hawkish ideas anymore. There was more about dovish. And that's actually also seen in the markets. Yesterday, also over, for example, strategy robot actually bought the dip quite nicely in 3 times. So exactly on the current dip. So regarding the market, of course, I cannot guarantee you that we will go lower. That's it's still possible, because this level of 56 actually is not the target level where actually we can go. We can go even lower, definitely, but let's see how it will happen. Let's go to the daily time frame to actually show why I say so. For example, also it's interesting to notice that there is this declining amount of volume trading already from the February, basically, when there is this highest traded volume currently. And then it was like declining until the point actually that yesterday, where there is also huge volume was traded. Therefore, it can be considered as probably close to the bottom. However, if you look to the chart, it doesn't look that much as the bottom yet. It just basically lost this sideways movement, lost the channel, lost the trend, and now is basically falling downwards. And therefore, I see it's still possible to reach down to 52k. I think it's still quite possible. Also, percentage wise, if you look to the chart, now we are down 23%. 23 is still not 33, 35, 33, 35%. That is also a normal correction for the bull run corrections, and therefore it's tricky, of course, to play this market right, because you never know what happens next day in the markets. But as I told you, basically, with our strategy, with our funds, we are always prepared for both scenarios, for the bullish scenario and also for the bearish scenario. And we are making money on basically on both scenarios and both directions. So everything for us there in that sense is calculated. Therefore, there are no major risks, and we don't actually stress about those kind of situations at all. So, because still currently I would say that it's still the same play, the same game. Basically, this potential to go down is much less than actually the potential to go up, and therefore the shorting is much more difficult. When we also short the market in the recent days a little bits by bit, but that's with the smaller amounts. Definitely with the smaller amounts, I think maybe 125% of the amount we are longing, we were shorting in the previous days. So it's still good to make some profits on the way down, but it's much riskier in the bull run actually to short the market, when it's actual bull run is probably, if we take it like from the very beginning, then I would say we are maybe in somewhere in the bottom, and actually this big move is just coming in the next couple of months. So, and therefore also here I see that the next move can be basically can be anything. So, and currently I don't see that we are stabilizing on the on the bottom, and then should be next move should be definitely upwards. I don't see that. I don't see that. There are news and rumors in the X platform or YouTube or others. They are telling buy the dip, and no, we are going just up, up, up. Well, probably not really the case. I don't see it like 90% chance. I see it like a less than 90% chance right now, because also, for example, today we don't see that much of the impulse to the upwards. We see even less than here right now. So we'll see what will happen next. But we can also trail back to 60, 62K region, maybe even higher to 64, and then have a next leg down to 52. That can be quite easily the scenario. So probably then some pushback again, and then maybe even the final leg to 48 or 50. So, and that will definitely make also the sense, because then it's percentage wise will be really good actually correction with the 35%. That's that's pretty normal for the bull runs to happen. And here we see that it cannot go probably that. Yeah, I would like to say that yeah, it can go in such speed. It can go. It's actually June. If you look to, for example, to the overall trend right now, maybe no, we will actually even increase. It can happen. Then we are down already on the bottom in the end of the May. That can happen too. So, and we can be there also in the June in the summer, and then by the July, August, then we start to trailing upwards. That's also actually quite logical in that sense, because the summer months are typically also vacation months, and they are maybe a little bit less active. So, therefore, also I see that there can be this stabilization in the summer months, and then actually this real move might start somewhere in the end of the July and August. That's quite possible. So, but definitely, if you are holding your spot, then you shouldn't care at all. Our funds also do not care that much, because we are basically making money from the any move, any direction. And that's being said, I would like to go also to, for example, one of our accounts, and you can see here that basically we were buying pretty nicely the bottom of this previous move. So we'll see what will happen next. And then we go to liquidity, and liquidity is really good to watch currently, because as you see there, and then there this maybe by seeing this liquidity chart, you can easily understand how the price actually can run so quickly to new all-time highs also. So here, from here, so that can be easily explained here, because there is so much short liquidation standing at 67, for example, 60, 67, 68K region. There are billions of liquidations, and there are also even more liquidations at 70, 71, 72K. There are like maybe 10 billion standing in this region. Then also here at 64, 65, there is also a kind of $1-2 billion in total. So therefore there is like huge volumes standing for the shorts to be liquidated, and on the way down there are a lot less actually to be liquidated. There is a lot less longs right now than the shorts in the markets. So therefore I would say that it's better to start longing. Better to start longing. If you are not yet longing, then it's better to start longing right now, because and this is the picture which is typically filled as cascade liquidations. And if we, for example, have some real push up some institutions decide that they are going in and buying big. So, and then you will see actually the price reaching those levels, for example, pretty quickly 61, 60, 62. And then we will shoot pretty quickly through all this region, and there will be huge impulse here, and there will be even more impulse here and here and here and here. And then I think in a couple of days we can land in 80, 90K region easily. So therefore, how it's happened? Because basically many shorts have been opened not here. Those shorts are not open from here. The most of the shorts are open from somewhere here or here. So and then they do not have stop loss. The stop loss is just liquidation price or somewhere far away, and then they will just see those losses growing, and psychologically they will not be able to sell. They will not want to sell with the loss, and the final moment will be just their liquidation, their margin call, because their own money will be lost completely, and that is liquidation in the markets. You know, they trade with the high leverage. Also, those who used to be liquidated, they trade with the high leverage, which basically means that they are, if they have a 100x leverage, then basically it means that if they have put in $1,000 of themselves and trading with the 100k, it means market have to move just 1% in the opposite direction and you are liquidated. That's simple, you know. And you are lost your 1,000, and then you are basically position is closed, and those actually taken money from the for the leverage is basically given back to the giver, with the even percentage earned on it. So that means that basically even quicker you are liquidated. So, and that's how it works, and that we will see definitely here a lot also when the price will start to run up, and there basically there won't there will not be needed any huge market players in this region. The market will along itself basically by making liquidations, because short liquidations means buying. There in this region there is no need for any big player to actually come in and buy the market. There is just will be the huge amount of liquidations, and those liquidation also will trigger those the same people to start longing. So then therefore that will be even more extra impulse to the upwards, and that can create also 100k Bitcoin in a couple of weeks, quite quickly. So, and that's the actually how the market logics works. Uh, with that being said, thank you for your attention. See you next time.